Hi friends, in this video we will mainly learn about the cash flow statement when profit and loss account is given. Cash flow statement is basically a technique in the business which helps business to understand from where the cash comes into the business and cash goes out of the business. So let's understand this and prepare cash flow statement with an example. So here we go. Statement if 2 years balance sheet and profit and loss account is as follows. So here 2 year balance sheet and profit and loss account is given. So let us first consider and understand what are the various items that are appearing on the balance sheet in year 1 and year 2. So on liability side, share capital of year 1 is 1000 and year 2 is also 1000. Retained earnings of year 1 is 600 and year 2 800. Trade payable 68 105. Other liabilities 200 140. So total liabilities is 1868 and 2045. On the asset side, fixed asset is 800 and 720. Investments 180. Trade receivable 668 745. Cash and bank balance 300 500. Total assets 1868 of year 1 and 2045 of year 2. Thus, in year 1, total liabilities is 1868 and total assets is 1868 and thus our balance sheet tallies. Also in year 2, total liabilities is 2045 and total assets is also 2045 and thus our balance sheet tallies. In case of P&L, year 1 revenue is 800 and year 2 1080. So total income of year 1 is 800 and year 2 1080. Operating expense 140 800, depreciation 60 80. So total expenses of year 1 is 200 and year 2 is 880. Profit is basically revenue minus expense. So 800 minus 200 is 600 and 1080 minus 880 is 200. So profit of year 1 is 600. Since this is the first year of operation, there is no opening profit and hence it is zero. Retained earning is basically opening profit plus profit during the year. So 600 plus 0 is 600. And this retained earning of year 1 later on transferred to year 2 as an opening profit. So that's why here 600 arises. Total income of year 2 is 1080. Total expenses is 880. Profit 200. Opening profit is 600 and retained earning of year 2 is 800. So this retained earning here matches in the balance sheet. So these 800 and these 800 are same. These 600 and these 600 are same. Thus year 1 and year 2 balance sheet and profit and loss account is given. And based on that we need to prepare cash flow statement. Now cash flow statement is of year 2 here. Now let us understand how to prepare cash flow statement. So as a first step, you have to take difference between 2 years, that is B minus A. So 1000 minus 1000 is 0. As there is no change in share capital, no impact on cash flow and hence cash flow amount is dash and cash flow presentation, there will not be any presentation in the cash flow. Retained earning of year 1 is 600 which increased to 800 in year 2. This is primarily due to profit, you can see here. So B minus A is 200. So there is an increase in liability item from 600 to 800. That is 200. So increase in liability results in increase in cash to tally the balance sheet. As liability side increases, you need to increase the asset side, that is cash, to tally the balance sheet. And hence increase in cash result into cash flow amount of 200, which is basically recorded as profit before tax in the cash flow statement. You can see here profit before tax 200. Third item is trade payable, which has increased from 68 in year 1 to 105 to year 2. That is increase is 37. So increase in liability results in increase in cash to tally the balance sheet. So increase in cash and hence cash flow amount is 37. That is this amount, which is basically recorded in a cash flow statement as 37. You can see, and it is basically increase in trade payables. So cash flow presentation is increase in trade payables. Other liability From 200 it goes to 140, that is minus 60. So decrease in liability results in decrease in cash to tally the balance sheet. So decrease in cash, that's why minus 60, and explanation is decrease in other liabilities. So minus 60 you can write here, which is decrease in other liabilities. On the balance sheet asset side, 800 of fixed asset becomes 720. So minus 80. That is 720 minus 800. So decrease in asset result in increase in cash to tally the balance sheet. As one item of the balance sheet asset side decreases to tally the balance sheet, you have to increase other item of the balance sheet asset side, which is basically cash in cash flow statement, and hence it is 80. Now basically is decrease, this is primarily due to depreciation. You can check here also, depreciation of year 2 is 80. So this 80 positive amount you are written in the cash flow statement 80 as a depreciation. Depreciation is basically reduction in the fixed assets value because of wear and tear of time. Now investment 100 become 80, so minus 20. So decrease in asset result in increase in cash to tally the balance sheet. So cash flow amount is 20 here, and it is sale of investment. So sale of investment 20. Trade receivable 668 becomes 745, so 77 increase. So increase in asset other than cash result in decrease in cash to tally the balance sheet, and hence due to 77 increase in trade receivable, we have to reduce the cash by 77. So minus 77 we will write here. This is basically increase in trade receivable results into the decrease in cash. Cash and bank balance is 300 of year 1 and 500 of year 2. So total difference is 200. So not to consider here. We will consider it at the later stage. So let us prepare, or rather we have prepared the actual cash flow statement. We have plotted all these differences here in the cash flow statement here. So net changes in cash, that is total of all above, is 200. Now opening cash balance of year 1 is 300. You can see here. Cash and bank balance of year 1 is 300. Total of above 2, that is A plus B, is 200 plus 300 is 500. Now actual cash balance of year 2 is also 500. You can check here. Actual cash balance of year 2 is 500. Thus, our cash flow tallies as calculated closing balance matches with actual cash balance of year 2, that is 500. Thus, we have prepared this cash flow statement where closing balance of cash flow of 500 matches with the actual closing balance of year 2 of cash, and thus our cash flow tallies. Thus to conclude, what we can say is that to prepare a cash flow statement, our first step is to make a comparison between the two period balance sheet. That is, take difference between year 2 balance sheet items versus year 1 balance sheet items. If there is an increase in asset other than cash, then to tally the balance sheet you have to reduce the cash, and hence all increase in assets are reduction in the cash and will be written as a negative amount in the cash flow statement. Similarly, if there is a decrease in the asset other than cash, then to tally the balance sheet you have to increase the cash, and hence it will be recorded as a positive amount in the cash flow statement. If there is a reduction in the balance sheet liability side, then to tally the balance sheet you have to reduce the cash, and hence all the reduction in liability will be recorded as a negative amount in the cash flow statement. And if there is an increase in the balance sheet liability side items between two balance sheet dates, then to tally the balance sheet you have to increase the cash to tally the balance sheet, and hence all these items are recorded as a positive amount in the cash flow statement. At the end, the closing balance of cash flow statement matches with the closing cash balance of year 2 balance sheet, and thus our cash flow statement tallies.